Stocks are rallying to kick off the new year, but a new report from the Wall Street Journal says a looming issue could lead to more volatility this year: liquidity. And as we turn to that issue, I want to ask you, when we're talking about liquidity, it's just my ability, if I own stock, to sell it, to go into the market.
Or to buy it.
Or to buy it, yeah.
That's right.
Yeah, it's to make a market.
Yep.
What is, in the real world, what does that look like right now? Because are people having trouble buying or selling?
Yeah, well, not in smaller size. I think the bigger issue, and we were actually talking to some of our institutional clients about this morning, is that you've seen certain market participants grow in size, particularly multi-strategy hedge funds, and use more and more leverage. And you've seen liquidity diminish significantly, not only in equities, but more importantly, corporate credit and high-yield bonds. A lot of that is due to regulatory reform from Wall Street. Just to give you a number we always focus on is, before the crisis, Wall Street prop desks and market makers owned 27% of the high-yield bond market. For the last 5 years, it's been 1% or below. So what that means is that whenever you get a sea change in risk appetite, the exit door is much thinner and you get much gappier price action. And if you think of what we've seen the past 3-4 years, so at the end of 15-16, tied to China and the devaluation, we saw gapping price action not only in equities but also high yield bonds and structured credit. In early January, February of 18, we saw a very violent correction, then a very violent rally back. And then in Q4, obviously, of last year, and then into Q1, another violent sell-off, violent back. So, the point for any investor is, if you're relying on liquidity to change your mind like that, that's a very faulty assumption. Assume whatever positions you're in, you're going to need 3, 6, 9 months to leg out. Wow. And that's the new normal on Wall Street. So if you run a big balance sheet and you need to reduce risk, you're going to be paying a much steeper price today than you were 5 years ago, and certainly in the pre-crisis period. I mean,
granted, the Wall Street Journal report was at least partially anecdotal, but they also point to equities. They talk to individual money managers who would try and get out of stocks, individual stocks, and could not do it. And they, of course, point the finger at the culprit that has been named over and over again, especially over the past year, and that's ETFs and passive investing, which has reduced the pool of liquidity, even though it's still, it's not the majority of the market, but it's getting. Well,
it's where all the growth has been, right?
Yeah,
no,
exactly.
So that is the other side of the equation. Where's the terminal demand? But our contention is that if balance sheets were still as large as they were even 5 or 6 years ago, that would be much less of an issue. When you combine the two, it can be a factor that certainly has to influence your investment decision-making process.
So how much of a risk, Troy, do you think this is, in terms of a systemic problem that we're potentially facing?
Well, so there's capital markets and there's a real economy. Right. We don't see it as a problem that could be systemic enough to cause, a downturn or exacerbate a slowdown by 50 basis points, but it could certainly take a mild sell-off, 5-10%, and turn it into what we saw in Q4 of last year. Again, we'll go back to the high-yield bond market. Roughly 15% of the high-yield bond market has overnight daily liquidity, and roughly 0.001% could actually be accessed. So if you get the next downturn, even if corporate credit does not deteriorate as much as it did in the crisis, you could see as large of a sell-off.
That rush to the exit, I am curious. Help us understand, would that be magnified for those who are passive investors through ETFs?
Yeah, well, it could be, because again, when those are being created or destroyed, which is actually the terminology, when they go to markets and try to access liquidity, if that liquidity is already being tapped by other active investors, then the price has to fall to adjust that for new buyers to come in. So, the bigger point is the upside of regulatory reform is that you have less systemic risk in the banking system and less systemic risk to the economy. The downside is you just have more sustained gappy price action.
And let me ask you, Joe, just specifically, for, say, people watching our show who are really looking to buy, say, 300 shares or 100 shares of Google, right?
Yeah.
You don't think there's any impact at all? Are you getting less efficient pricing, AKA paying more?
I think a volume of that size for a stock with that average daily trading volume, it's highly unlikely. But when you're talking institutional investors or larger family offices, the impact is more significant. Still de minimis, but more significant today than 10 years ago.
And it could lead to some scariness in terms of exacerbated market moves, though.
Yes. Yeah. Well, we've seen some examples of that.
Well, yeah. Think about Q4, Q1. You were down almost 20% peak to trough, and then the Fed said, "Hey, we're not going to hike anymore," and before you know it, boom, back up. So
remember that last December and last January, and here we are.
Yeah, December 24th.
Right. I remember that day before.
equities hit 13.6 times forward earnings, and today they're somewhere between 18 and 18.5 times forward earnings.
It's amazing.
That's a big rebound.
Yep.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.